In the high-stakes world of investing, where confidence often reigns supreme, there's a counterintuitive trait that may provide the most significant competitive edge: intellectual humility. As investment analysts, our ability to admit, "I might be wrong," could be our most valuable asset. In this video, I'd like to explore the crucial role of intellectual humility in successful investing and how it can set exceptional investors apart from the rest. Intellectual humility is essentially the opposite of intellectual arrogance or conceit. It's akin to open-mindedness, the ability to hold firm beliefs while recognizing one's fallibility and willingness to be proven wrong. This trait is essential in a field where certainty is often an illusion, and the interplay of countless variables can confound even the most sophisticated analyses. The dangers of overconfidence in investing are well documented and numerous. Consider the near-universal certainty among pundits that Hillary Clinton would win the 2016 US presidential election, coupled with predictions of a stock market collapse if Donald Trump were to win. Both predictions proved spectacularly wrong, with Trump winning and the market rising over 30% in the following 14 months. Similarly, in mid-2022, there was widespread certainty that the Federal Reserve's interest rate increases would precipitate a recession. Yet, as of mid-2024, no recession has materialized. These examples underscore a critical point. In fields influenced by psychological fluctuations, irrationality, and randomness, such as politics, economics, and investing, certainty is often misplaced. Embracing intellectual humility leads to several tangible benefits for investors. When we acknowledge the possibility of being wrong, we're more likely to investigate thoroughly before investing. This approach leads to more comprehensive due diligence and a deeper understanding of potential investments. Intellectual humility fosters a willingness to consider opposing perspectives. This openness can lead to more balanced analyses and identifying blind spots in our thinking. Recognizing our fallibility encourages a more cautious approach to risk. We may sub-optimize when times are good, but are less likely to experience catastrophic losses. Intellectual humility promotes a growth mindset. By being open to learning from mistakes and new information, investors can continually refine their strategies and understanding of the markets. Cultivating intellectual humility requires conscious effort. Here are some strategies. Acknowledge, no one can predict the future with certainty, especially in complex systems like financial markets. Instead of seeking certainty and becoming comfortable with probabilistic thinking and scenario planning, view errors not as failures, but as opportunities for growth and refinement of investment strategies. Actively engage with viewpoints that challenge your own. This can help identify potential flaws in your reasoning. Avoid absolute terms like will, won't, always, and never in your analyses and predictions. The contrast between humble and overconfident approaches is stark in the investment world. Consider the case of long-term capital management, a hedge fund that boasted Nobel laureates among its principals. Despite their brilliant minds and sophisticated models, their overconfidence led to a spectacular collapse that nearly caused a global financial crisis. On the other hand, investors like Warren Buffett have consistently demonstrated intellectual humility, acknowledging the limits of their knowledge and adapting their strategies accordingly. Intellectual humility provides a significant competitive edge. It leads to more nuanced analyses, better prepared strategies, and greater adaptability in the face of market changes. Investors who embrace this trait are less likely to be blindsided by unexpected events, and more likely to recognize and capitalize on opportunities that others might overlook due to rigid thinking. Intellectual humility can be particularly valuable in market forecasting. The financial world is littered with failed predictions from supposed experts. Those who approach forecasting with humility, acknowledging the inherent uncertainty and complexity of markets, are more likely to provide valuable insights and avoid the pitfalls of overconfidence. Moreover, intellectual humility can enhance team dynamics and decision-making processes within investment firms. When team members feel comfortable expressing doubts or challenging assumptions, they make more robust analyses and better-informed decisions. This culture of openness and humility can be a significant competitive advantage in the long run. In conclusion, as investment analysts, we operate in a field where certainty is often an illusion. and the interplay of countless variables can confound even the most sophisticated analyses. By cultivating intellectual humility, recognizing our fallibility, embracing uncertainty, and remaining open to new information and perspectives, we can enhance our decision-making processes and ultimately achieve better investment outcomes. Doubt may not be a pleasant condition, but in the complex world of investing, embracing this doubt and the intellectual humility it engenders may be our greatest strength. It allows us to navigate the inherent uncertainties of the market with greater wisdom and resilience, ultimately leading to more sustainable success in our investment endeavors.